Following up Senator Johnson's question, which was about a default on our outstanding obligations as the federal government, some have suggested that if we cannot resolve the debt ceiling limit, we simply prioritize payments. We presumably pay on some treasuries as long as we can, pay principal, some interest. That, of course, requires us to not pay on things like military pay and Social Security. But just in the context of the financial sector, would that fix the problem? Simply, you know, not having the debt limit extended and trying to pay as long as we can on our securities?
Well, Senator Reid, first of all, of course, it's the Treasury's area to determine how they're going to manage this. They've been pretty clear that they don't think it's either appropriate or feasible to prioritize. And as the fiscal agent, the Federal Reserve simply does what they tell us to do, and I think there are in fact some operational issues that arise if you were to try to do it. But again, the Treasury is the determinant of this, and they are pretty clear that they don't think that's a workable solution. That being said, whether default is on securities or whether it's on payments we owe to Medicare recipients, it's going to constitute a default of some type on obligations incurred by the U.S. government, and it will certainly have an impact on both the economy but also on confidence. You know, what inference should investors take from the fact that the U.S. is not paying its bills and that it can't resolve this issue? So I think that you know, no matter, there's not really any solution other than to find a way to solve these problems, to address the fiscal issues, and to raise the debt limit at the appropriate time.
Let me just explore a little bit. Moody's today and Standard & Poor's have suggested that they are putting us on a watch, downgrading, and what clearly is behind them is that if we do not pass the debt limits ceiling, raise them, they will downgrade us. Not only U.S. Treasuries, but Moody's has indicated Fannie Mae paper, Freddie Mac paper, Federal Credit Bureau paper, and we have also placed for possible downgrade securities either guaranteed by, backed by, collateral securities issued by, or otherwise directly linked to the United States government. So essentially, they're going to downgrade things we don't even know yet. Maybe you know. What does this do in terms of interest rates across the board? Likely raise them, even in a, quote, technical default?
Well, the combination of downgrades, which we were already seeing it, by the way, we're still some weeks away from the deadline, and loss of investor confidence could potentially raise interest rates quite significantly. And the ironic aspect of that, of course, is what we're all interested in doing is reducing the deficit. If you raise interest rates, that means your interest costs go up substantially, and you're actually making, you're regressing rather than progressing in terms of...
So a failure to raise the debt ceiling limit would be probably the most significant immediate increase in the deficit that we're likely to see, the one act that would dramatically increase the deficit.
It would be a self-inflicted wound, I would say.
Let me ask about something else, too, and that is, because you've talked about a fiscal crisis but also a jobs crisis. What's your presumption into this scenario about jobs? Are we likely to see people eagerly going out and hiring under this situation of technical or real default?
Well, I mean, we have a recent example in 2008 when the financial system froze up and we saw an immediate, very sharp contraction in the global economy. Even if things didn't get that bad, and it's one of the key issues here is it's very hard to predict exactly what's going to happen, but if interest rates rise, that's clearly going to reduce investment. Uncertainty will rise. That will reduce the willingness of firms to hire and invest. So I can only, and of course, if the government is reducing its payments by 40%, that's going to have an impact as well. So right. I can only conclude that this would be very bad for jobs.
Let me ask you another area which we discovered, much to our chagrin, was a huge and explosive problem. That is the situation of derivatives. I would presume that there are a lot of credit default swaps written on many of these securities, et cetera, and that if they are downgraded, that could be a condition of default. That could require additional collateral. Do you have any idea on the institutions that you regulate, the potential exposure they would have as credit ratings fall or as there is a default in the market? Is it in the trillions?
There are many knock-on effects from a default ranging throughout the entire system, but CDS directly on treasuries as opposed to on other securities are actually not that big. So, and it would take an action of the ISDA to invoke, the credit event. So that could be a problem for some institutions, but it wouldn't be the biggest problem among all the things that we've been discussing.
But your point, which I want to reiterate, is that this could be a self-inflicted wound doing more damage to the deficit than it's been done to date.
It's really not an option we should be considering.
Just so I may, one question is, who's the largest holder of our Treasury debt and our agency debt? Is it the Chinese government or Chinese institutions, or do you?
Well, the Fed has a lot of.
You have a lot of it.
Chinese, I think, probably right.
Right after the Fed would be the Chinese.
As an individual institution, the reserve holding, the central bank that holds the reserves.
Of China.
Of China, yeah.
So effectively, if we were to be paying our debt and not paying our Social Security payments, we would be principally paying the Chinese central bank in lieu of paying Americans.
That's right, but if we didn't do that, of course, we would suffer financial consequences.
I completely concur, and I think that the solution is to appropriate raise the debt ceiling, deal with the fiscal and issues of the deficit that we face, and we're trying to do that. But just ironically, when you do this sort of prioritization, the irony is the priority is to the Chinese central bank, and lower on the pecking order would practically be seniors and Social Security recipients and maybe even American military personnel. I think that's the reality, isn't it?
Well, again, if prioritization were even feasible.
Was even feasible, and your point is you don't believe it's even feasible. Well, Mr. Chairman, thank you again, not only for your testimony today, but your service to the nation.